Over the last 20 months, I made £336 and an investment return of 26.49% by simply investing £25 a week into the S&P 500. No day trading, no stock picking expertise, and no complicated strategies. Saving a grand total of £2,585 without even realising how much I'd accumulated. Now, most people see those numbers and think it's either luck or some sophisticated trading strategy. The good news is that it's neither. It's a result of one simple approach: consistent automated investment combined with a robust index fund and patience. In this video, I'll show exactly how this works, why it matters, and most importantly, how you can replicate it. Although I discuss the figures in GBP in this video is intended for a global audience, and therefore you can replace any currency with your local one. I highly encourage you to keep watching until the end, as getting this right can make you a lot of money over the long term. Before we talk about my returns, let's establish why the S&P 500 is the foundation of this strategy. The S&P 500 isn't a speculative vehicle. It's the 500 largest and most established companies in the United States. Firms like Apple, Microsoft, Nvidia, and Amazon. These aren't high-risk, high-reward startups. These are global leaders generating profit, innovating and creating shareholder value daily. Historically, the S&P 500 has delivered approximately 9 to 10% annualized returns over the long term. My 26.49% time-weighted return over the last 20 months significantly outpaces that average. But here is the important context. 2024 and early 2025 have been exceptional years for the market, particularly in the technology and the artificial intelligence space. By investing in the S&P 500 rather than individual stocks or other vehicles, you create something that many finance and risk experts love: diversification. With one investment, you own a slice of 500 different companies across multiple sectors. If one company underperforms, 499 others carry you forward. This reduces risk, and it's why institutions and billionaires invest heavily in index funds. Not because it's exciting, because it works. Although all markets experience turbulence and crashes, something that we are actually seeing right now in fact, over the long term, the S&P 500 has always gone up, as you can see on screen now. Despite extremely scary times such as the dot-com bubble, the 2008 financial crisis, and also the COVID crash. Every recession, every crash, every correction has been followed by recovery and growth. If you can stay invested through the volatility, the long-term trend is unmistakably upwards. Now, the technical reason that my £25 a week approach works so effectively comes down to something called dollar cost averaging, or DCA. Every single week, £25 leaves my account and it enters the S&P 500 index fund, in this case in my Invest Engine account. However, I also love using Trading 212. This happens automatically. I don't think about it, I don't watch market prices, and I don't wait for the perfect moment. Every week, £25 goes into the account regardless of the conditions. Now, this point is extremely important. When the markets are expensive, my £25 purchases fewer shares. But when the markets decline and the prices drop, moments when most people are panic selling, such as this week, my £25 purchases more shares at lower prices. Over time, this averaging mechanism ensures that my cost per share is optimized. I'm actually systematically buying low when other people are fearful. As you're probably aware, this is classic advice from the renowned investing guru Warren Buffett. Now, if you consider what happened across 2024 and 2025, we have experienced significant market pullbacks.
European stock markets have continued to plummet after both last week's losses and following huge drops earlier today in markets.
In the media, commentators warned about crashes, yet my automatic investing continued unchanged. Every dip meant my £25 was buying more shares at better prices that week. When the market recovered, as markets historically do, those shares purchased at the discounted prices became my biggest gains. The time-weighted return calculation accounts for this perfectly. It recognises that I haven't made a single contribution, but I've made 85 regular contributions at varying market prices. The 26.49% figure represents the actual return on my invested capital adjusted for this timing. It's the fairest measure of my portfolio's true performance. Now, if we compare this to someone who tried to time the market, They might have invested the whole £2,250 at once when market prices were high, and therefore missed any subsequent dips, ultimately achieving a suboptimal return. Or even worse, they could have panic sold during downturns, crystallizing these losses. The DCA approach sidesteps these psychological tactical errors through automation and discipline. Now, if you don't currently use Trading 212 and you'd like a free fractional share worth up to £100 or €100, $100 or your local equivalent currency when you sign up, please feel free to use my sponsor code DEAN or the link in the description. But please do note that some terms and conditions do apply, so please read them carefully. Here is what most people don't understand about compound growth. The gains actually accelerate exponentially, particularly in the latter phases of your investment timeline. And this is where the real magic happens. In my first 8 months of investing from April to November 2024, I accumulated £800 in contributions and achieved very modest gains. That initial period felt slow and it almost felt flat on the charts as you can see on screen. Being completely honest, the returns were encouraging but weren't dramatic. And if they stayed like that, you could easily lose motivation. However, look at what happened over the past 12 months. Despite a significant market crash and ongoing volatility, I achieved a gain of £247 with an 11.37 time-weighted return even through that correction. This is the crucial transition point in my portfolio. Let me explain why this matters so profoundly. In the early years of investing, compound growth is relatively linear. Your gains do compound, but on a relatively small basis. But as your portfolio grows, those same percentage returns generate substantially larger gains. A 15% return on £1,060 generates £240. Now a 15% return on £5,000 generates £750. Then a 15% return on £20,000 generates you £3,000. The percentage does stay the same, but the pounds accumulate faster. This is the mathematics of exponential growth, and it's why starting early is absolutely critical. Now, over my lifetime, if I'd waited just 5 years more to begin investing, I would have compressed my compound growth timeline significantly. Every year you delay is a year of compounding you can never recover. Over the next 10 years, assuming even a conservative 10% annual return, this portfolio will grow exponentially. In a further 10 years, I forecast that I'll have £29,189 with 13.6k coming from compound growth alone. In 30 years, by investing that same £25 weekly, I will have a forecast of £296,000. with $254,000 coming from compound growth alone, assuming that I maintain consistency and don't panic sell during inevitable downturns. At this point, wealth creation becomes life-altering. Now, this isn't exaggeration, it is purely mathematics. It's the power of time combined with a consistent contribution and market returns. And this acceleration is why you see billionaires and long-term investors obsess with timing the market, not trying to time the market. They understand that the bulk of wealth wasn't created in the first decade, but it was actually created in decades 2, 3, and 4, when compound interest was working on a substantially larger pot of money. Now, I don't know about you, but I find this stuff incredible. And once I started to understand this is when my wealth accumulation really grew. So, unless you're living under a rock, you've probably noticed the news is somewhat chaotic right now. Markets are experiencing extreme volatility. Technology stocks have pulled back, the investment media is then oscillating between euphoria and panic.
So we've seen losses in the UK, we've seen losses in Europe. Where is this going?
Confirmation from Hong Kong that its stock exchange has closed down more than 13% today, that it's its worst single day in 30 years, since 1997 in the financial crash.
Even today, Bitcoin hit $82,000. So you might be asking, what is actually happening? The primary driver has been tariff uncertainty. In April 2025, the US administration announced sweeping tariff policies. What was dubbed as Liberation Day triggered significant market corrections. Global stock markets declined dramatically, and investors feared that a trade war would impact corporate earnings and economic growth. This was the largest global market decline since COVID-19. The second primary driver includes concerns about artificial intelligence spending levels, with some investors question whether technology companies are spending way too much and too aggressively on AI infrastructure without clear near-term returns. Additionally, there have been discussions about rising valuations in the technology sector, with a few analysts saying that the markets are way overstretched. Most recently, in November 25, the information technology sector has experienced some weakness as investors rotate into more defensive sectors, creating the volatility that you're seeing now. There are also ongoing discussions about Federal Reserve policy and whether additional interest rate cuts will actually occur. In addition to this, there is growing concern that we're in a pre-2008 style crisis in the private credit lending industry, with some of the large banks realizing significant losses in recent weeks as companies have defaulted and gone bankrupt. Now, here is what is critical to understand. This is completely normal. Markets correct, markets crash, markets recover. Every market crash in history has eventually been followed by a new all-time highs, as you can see in this chart on screen now. Now, don't get me wrong, markets could crash hard in the next few months. But if you follow the DCA approach and don't need your money in the short term, this isn't necessarily a bad thing for you. Now, I also want to talk about why you need not worry if you're using the dollar cost averaging approach, as market crashes aren't catastrophes for you, they're actually opportunities. Let me explain why. When the market crashed in April 2025, investors who invested lump sums were devastated. Those who then panic sold crystallized massive losses. But for the dollar cost averaging investor like myself, we simply kept investing. Every week, £25 went into the market, and guess what? We were buying shares at dramatically discounted prices. We were still purchasing our shares during maximum market fear, exactly when the wisest investors also buy. Now, if you think about this rationally, and if you believe in the S&P 500's long-term prospects, and honestly, I think you should, given 100 years of data showing market resilience, then price discounts are gifts. A 20% market correction means that I'm buying the same companies with the same diversification at a 20% discount. In my view, that is a sale. Moreover, markets recover. Historically, they always have. The April 2025 crash was severe, as you can see on screen. Even my portfolio was in loss territory. But by June, the S&P 500 had already reclaimed its previous levels, and I was nicely back into profit. Then, by October, it was hitting record highs. Those who panic sold in April missed the recovery entirely. Those who continued their disciplined DCA strategy captured the entire move. This is why so many people say that dollar cost averaging is psychologically superior to lump sum investing during volatile periods. You're not exposed to the emotional agony of timing, and you're not sitting on cash wondering if you should deploy it. You're simply following the process. And that process, combined with volatility, accelerates your wealth building. Now, consider my recent 12-month performance. I've made £247 in gains despite a major crash. That is an 11.37% return through genuine chaos due to the power of consistency. Now we've discussed all this, I want to talk about the key points I think you need to take from this video. First, and that is understanding that investing isn't complicated or risky if you approach it correctly. The S&P 500 accessed through any major investment platform, whether that's Trading 212, Invest Engine, your bank, or a proper investment account, is accessible to anyone earning a salary or running a business. Second, this is automate the process. Set up a standing order for whatever you can afford weekly. If £25 feels like too much, then start with £5 or £10. The amount is secondary to the habit that you're building. Consistency beats perfection. Third, and this is to ignore market noise. When the news screams about crashes, when your friend panic sells, when volatility spikes, your automated investment is simply continuing its process. You're buying at lower prices during downturns. You're also capturing the gains during upswings. You're positioned correctly regardless of the short-term volatility and drama that you're experiencing. So if you think about it, the April 2025 crash, even the market crash that we're experiencing now, this is a time to celebrate because shares are on sale and you should not get involved in the panic. And finally, give it time. My 20-month track record is promising, but it's not the real test. The real test is in 5, 10, and 20 years of consistent investing. The wealth creation comes from compound growth, and it happens in the latter portion of the timeline. If you start today, in a decade, you'll wonder why you didn't start sooner. Now, if you found this video, the YouTube algorithm also thinks that you'll love this video here. I highly recommend that you watch it. Until next time.